In 2015, American Airlines was valued as a total company at roughly $8 billion. But the internal spreadsheet tracking their frequent
Right,
flyers.
just the digital list.
Yeah, exactly. That digital list was valued at over $31 billion.
Oh, it's just wild to think about.
It really is. Today, we are looking at how a digital list became worth, nearly 4 times more than the actual physical airplanes, the terminals, and, well, the entire global infrastructure combined.
Yeah, it completely flips the script.
Welcome to the deep dive. We are jumping into this really fascinating presentation from Navi. And the entire mission today is to open our third eye to see data not just as like IT exhaust, but as a tangible, hard financial asset.
Which is so crucial right now.
Right. We're going to explore how businesses either strike absolute gold or go completely bankrupt, based entirely on whether they have the ability to, mathematically see the value of the information they're sitting on.
And this forces a complete rewiring of how you look at modern business. I mean, we constantly hear people throw around these sweeping metaphors like data is the new oil.
Oh, yeah, you hear that everywhere.
Right. But when it actually comes time to audit a company's worth, that so-called oil usually just, vanishes into thin
Right,
air.
because it's not on the spreadsheet.
Exactly. It gets treated like an intangible byproduct of doing business rather than the core asset that is actually generating the wealth. And the shift in perspective is actively reshaping global economics, bankruptcies, and even massive corporate mergers.
To really grasp this, there is this brilliant aha moment right at the beginning of the source material.
Oh, I love this part.
It's so good. It points out that a stream of digital bits, so a string of zeros and ones like 0, 1, 0, 0, 0, 1, 0, 0, is completely meaningless on its own.
Right, it carries zero inherent value.
Exactly. Value only appears based on the lens through which we choose to process it. So through a technical lens, it might just be a character code. Through a legal lens, it's a liability under a privacy law.
And through a CFO's lens, it is a direct revenue stream.
Yes. The meaning requires an active choice. It makes me think of like an unread book sitting on a shelf. Physically, it is just ink smeared on processed wood pulp.
Just paper and glue.
Right. It has no actual meaning or value until a human being chooses to pick it up, read it, and, interpret those symbols into a story or an idea. Data is the exact same way.
It really is. It's just digital ink until a company decides to build a framework to value it. You have to assign context to the raw information to invent that value. Until you do, it's entirely dormant.
And the failure to build that framework?
Oh, it can be absolutely fatal.
Yeah.
When leadership teams lack that vision, they start making decisions based on an incomplete reality, which often leads to catastrophic financial failures.
Let's look at the Net4 India blunder highlighted in our sources, because it perfectly illustrates this high cost of data blindness.
It's a tragic case study, honestly.
It really is. So, Net4 India was an active operating internet services company. But a few years ago, they were dragged into bankruptcy court and liquidated over a debt of roughly $12 million US.
Which is a lot of money, but...
But they couldn't pay the cash, so the courts just shut them down.
Right. But the real tragedy of their balance sheet is what they were holding at the time of that liquidation.
Yeah.
Net4 India had 300,000 registered subscribers.
Oh.
And those weren't just like idle email addresses on a newsletter. They represented concrete renewal commitments generating roughly $2.5 million in revenue every single year.
Okay, let's unpack this, because if you take that recurring revenue stream of $2.5 million and you capitalize it, say, at a highly conservative 10%, that customer data asset alone is worth $25 million.
Exactly. They were liquidated over a $12 million debt while sitting on a $25 million asset.
That is just mind-blowing.
The asset was there. The value was entirely real and mathematically provable. But traditional accounting frameworks simply didn't have a standardized box to recognize subscriber data as a hard asset to offset a financial debt.
It's like a bakery going bankrupt and shutting its doors because they couldn't afford flour, completely ignoring the fact that the proprietary recipe book locked in their safe was worth enough to buy the entire neighborhood.
That is a perfect analogy.
They just starved to death while holding the winning lottery ticket.
And that conceptual blindness isn't limited to just struggling mid-sized companies either. The source presentation scales this up to a national level, looking at CIBIL.
Right, India's primary credit information bureau.
Yes, they held the highly sensitive financial data, so loan histories, default rates, credit limits for essentially the entire Indian economy.
And according to the timeline in the source, back in 2001, a foreign entity named TransUnion held a 10% minority stake in this bureau, acting mostly as like a technology partner.
Mostly just providing the software architecture.
Right. But over the next decade and a half, they quietly increased their stake, eventually securing regulatory approval to become the majority owner, controlling over 92% of the company.
Yeah, they transitioned from being the IT guys to owning the primary financial data of roughly 1 billion citizens.
1 billion.
And the final buyout phase really exposes the valuation disconnect. In 2017, a couple of major domestic banks sold their remaining 5% blocks to TransUnion.
Okay.
Based on the price of those shares, the total enterprise valuation for the entire National Credit Bureau was pegged at roughly $592 million US.
Here's where it gets really interesting. A little over $500 million for the verified financial lives of 1 billion people.
It seems incredibly low.
It does. And the presentation contrasts that corporate valuation with the raw street-level utility of data by looking at the dark web price index.
Oh, this is where the math gets crazy.
Yeah. On the dark web, a single cloned credit card fetches about $25. A European passport goes for up to $6,500. Even a basic hacked social media account goes for $35 to $65.
So the author runs a hypothetical calculation. If you take the highly sensitive, verified financial histories of 1 billion people and you value that data at an incredibly conservative $100 per person based on those dark web utility metrics.
Which is super conservative.
Extremely. That data pool could hypothetically be valued at over $100 billion.
$100 billion. And the entire company changed hands at an enterprise valuation of less than $600 million.
Yeah, the gap is just staggering.
It sounds almost conspiratorial, right? I mean, did financial regulators like the RBI or CBI just let an asset of that magnitude walk out the door for pennies on the dollar?
Well, this raises an important question. And the presentation we're looking at makes a compelling argument that this wasn't some malicious grand conspiracy.
Okay, so what was it?
It was a case of total conceptual blindness. The regulatory bodies simply didn't have the accounting tools to realize what was actually being traded.
Oh, wow.
Yeah, they were regulating the equity, the physical shares, the server infrastructure, and completely missing that the data pipes themselves were the actual crown jewels.
But wait, if data is worth that much and traditional accounting is missing it, what happens when a company actually figures it out? Like when they suddenly realize the recipe book is worth more than the bakery.
It completely flips their financial destiny, especially in distressed situations. Look at the electronics retailer Radio Shack during their 2015 liquidation.
Oh, I remember that.
The physical stores were failing, but they managed to recover over $26 million simply by auctioning off a database of 117 million customer records to a hedge fund.
Just the records.
Just the digital list. This is one of their most liquid assets.
Or look at Caesars Entertainment.
Casinos. Right. When they went through bankruptcy restructuring, the creditors brought in appraisers who realized that the Caesars Total Rewards customer loyalty database was worth over $1 billion.
$1 billion just for the loyalty program.
Yes. The digital records detailing who likes to play specific slot machines on Tuesdays or who prefers a corner hotel room was mathematically worth more than the steel, glass, and real estate of their most famous physical casino properties.
That is insane.
It is, because that data allows for highly targeted, guaranteed future revenue generation. You don't have to guess what a customer wants. You have $1 billion roadmap to their wallet.
Right.
Which brings us back to the airline industry paradox you mentioned at the start of the deep dive.
Okay, yes, let's unpack this because this is the ultimate tail wagging the dog scenario. When third-party appraisers looked at United Airlines Mileage Plus program, they valued just the loyalty data at $20 million.
Incredible.
But the market capitalization for the entire airline, so every plane, every gate, every pilot, was only about $9 billion.
And American Airlines was in the exact same boat. The airline's total market cap was under $8 billion. But their Advantage program data was valued at up to $31.5 billion.
Explain the mechanism here. Why would Wall Street, or any rational accountant, value a spreadsheet of frequent flyers at 3 or 4 times the value of a global transportation fleet?
Because physical assets are massive liabilities.
Oh, I see.
Airplanes depreciate the second they roll off the assembly line. They require millions in jet fuel, endless mechanical maintenance, unionized labor negotiations, and they just sit idle during bad weather. The profit margins on actually flying a metal tube through the sky are razor thin.
But the data.
The loyalty database is essentially cure margin. It is a highly predictive engine of future consumer behavior. Banks and financial institutions look at that database and see guaranteed recurring cash flow.
So it's basically a money printer.
Exactly. In fact, these airlines actively secured multi-billion-dollar survival loans by using this customer loyalty data as the collateral.
Wait, they use data as collateral for a bank loan?
Yes. The banks didn't want the airplanes. If the airline defaults, the bank doesn't want to figure out how to sell a used Boeing 737. But they absolutely know how to monetize a database of affluent, loyal business travelers.
Okay, so the airlines use data as collateral to secure billions in cash. We see the stakes. But how do we actually get to these specific numbers?
That's the real challenge, yeah.
Because it's easy for us to throw around a $30 billion valuation for a frequent flyer program, but how does a chief financial officer mathematically justify that on a balance sheet without just, wildly guessing?
Well, the source outlines 3 foundational lenses that finance teams use for data valuation, depending entirely on the context of the transaction. The first is future revenue potential.
Okay.
You look at the data you hold, and you calculate how much direct revenue it will generate over the next 5 to 10 years.
That makes sense for something like an initial public offering, right? When you are trying to convince new investors to buy in based on your growth trajectory.
Exactly. You are selling the promise of what the data will do. But if you are in a merger and acquisition scenario, say one tech giant buying a smaller rival, you use the second lens, current market price.
Because the buyer doesn't care about your internal projections.
Right. They look at what similar data sets are actively fetching on the open market today.
And I imagine the third lens is the most conservative one for everyday accounting. You just look at the literal cost of creation or acquisition.
That is the bedrock for traditional accounting standards. You calculate what it literally cost your company in server space, marketing acquisition campaigns, and labor to build, clean, and aggregate that specific database.
But the presentation also gives us a core mathematical formula to start standardizing this across industries.
Yes, the basic equation.
It states that for any specific data set, the baseline equation is volume multiplied by unit value. Volume is straightforward, like you have 10 million customer records. But the complexity lies entirely in defining that unit value. How much is one single row on that spreadsheet actually worth?
To figure out that unit value, appraisers look at 3 key parameters. The first is depth, which refers to the richness and specificity of the record.
So a record that just says John Smith, New York, has very low depth. It's practically useless. But a record that includes John Smith's specific medical history, his credit score, and his real-time GPS location has incredible depth.
Right, and therefore a much higher unit value. The second parameter is sensitivity, which is the legal significance and the risk associated with holding the data.
Got it.
And the third parameter is reliability, because if the data is outdated or full of errors, its financial value plummets.
And to measure that reliability, the source breaks it down into the 5 V's of data quality. Let's make sure we really understand how these mechanics work, because it's not just corporate jargon.
Right, let's break them down. The first 2 are volume, so the sheer mass of the data, and velocity, which is the speed at which it is ingested and processed.
Velocity is a huge one. Think about a credit card company during the Black Friday shopping rush. Their data has immense velocity because they are ingesting millions of transactions per minute, allowing them to spot fraud in real time.
Exactly. If that data arrived a week late, it would be useless.
Totally.
The third V is variety. So does your data set only contain text, or does it integrate video, audio, and sensor data? The wider the variety, the richer the insights.
Makes sense.
The fourth is veracity, which is the trustworthiness of the data. Dirty, unverified data poisons financial models.
Like if your database is full of fake email addresses or expired credit cards, the veracity is 0.
Precisely. And all of those feed into the 5th V, value, the ultimate financial translation of how those first 4 metrics combine to create a usable asset.
Let me push back on something here, though, regarding those earlier parameters.
Sure.
If data value increases with depth, meaning the more specific, personal, and identifiable a record is, the more a company can charge for it. Doesn't anonymizing data completely destroy its financial value?
That's a great question.
Because if I take a medical database and strip out all the names and contact info to comply with privacy laws, haven't I just ruined the depth of the data?
What's fascinating here is how the legal framework actually shifts the financial calculus.
Yeah.
You were absolutely right that anonymization reduces the individual depth of a record. You no longer know exactly who the person is.
Right.
However, by anonymizing it, you drastically lower its sensitivity.
Meaning you strip away the legal liability.
Yes, highly sensitive personal data is incredibly restricted. You can't easily sell it, you can't freely share it across borders, and if you get hacked, the fines can bankrupt you.
Oh, that makes so much sense.
But the moment you anonymize it, it becomes an aggregated trend. You remove the strict legal friction, which makes the data set highly liquid. It becomes much easier to trade, share, and utilize in corporate research or AI training models.
So you trade individual depth for market liquidity. That perfectly bridges us into the legal side of things because the law literally dictates the price tag. The source visualizes this dynamic as a sensitivity pyramid to show how legal weight creates market scarcity.
Right. At the wide base of this pyramid, you have general personal data. This is basic demographic information, ordinary profile details. It has baseline legal protection, but it's abundant, so the market value per record is relatively low.
Moving up to the middle tier, you hit identifiable data. This is where you bring in contact details, tax numbers, government IDs. So information directly linked to a specific, unique identity.
And the legal compliance gets stricter, and the value goes up.
Right. And at the very peak of the pyramid is critical or sensitive personal data. We are talking about biometric scans, real-time health monitors, banking passwords, and even deeply personal political or religious beliefs.
Because this data can cause massive harm if leaked, the legal barriers to holding it are immense.
Yeah.
And ironically, that high barrier to entry creates extreme scarcity, allowing companies that legally possess it to command the highest premiums in the market.
To make this incredibly tangible for you, the source looks at domain names as microassets to show how this utility in data flow drives real-world pricing. It compares two different websites.
This is a great example.
A domain like iccbank.com, which is a major banking hub, has an automated market value estimated at over $921,000. Why? Because of the sheer utility of the data pipes.
It handles massive daily transactional volumes.
Exactly, and highly sensitive customer verification flows.
Then compare that to a specialized knowledge portal like Navi.org, which the presentation value is at around $13,600.
Quite a difference.
It is a highly respected niche asset, but it doesn't process the same volume of highly sensitive, critical financial data. The utility of the data actively flowing through the infrastructure is what defines the ultimate price tag of the asset.
So we can clearly see the value and we understand the mechanics of how CFOs and appraisers calculate it. What are we actually supposed to do with this knowledge?
Well, the source lays out a practical framework for professionals.
Built around what they call the 3 Rs, right?
Yes. The 3 Rs are a roadmap to stop the data blindness we saw with Net4 India. They stand for recognize, reveal, and report.
Okay, so walk us through those.
First, professionals must recognize the value of data as a genuine asset. You have to stop viewing your customer list as just an IT tool and see it as capital.
Second is reveal. You have to actually build the accounting models to show this data valuation explicitly on your internal balance sheets. You have to drag this hidden asset out of the server room and put it squarely on the CFO's desk.
And third is report. Bring visibility to this asset for your management teams, your investors, and government tax authorities.
And this isn't just theoretical advice for a PowerPoint presentation either. Major institutional changes are already underway. The source points out that national auditing bodies, like the CAG, are actively pushing to reflect the fair value of data in the assets of state-owned enterprises.
Exactly. Furthermore, data protection groups like the FDPPI are formally proposing standardized frameworks, like a Data Valuation Standard of India or DVSI, directly to chartered accountants.
If we connect this to the bigger picture, they are actively trying to rewrite the foundational rules of corporate accounting.
To finally catch up with the reality of the digital age. When these standards are universally adopted, it will fundamentally change how enterprises are valued, how startups secure their initial loans, and how national wealth is measured and protected in a global economy.
So what does this all mean for you listening right now? Whether you are running a small tech startup, managing a corporate team in a legacy manufacturing industry, or just navigating the digital economy every single day, you are both hoarding and generating data.
Constantly.
The fundamental question you have to ask yourself is, are you mathematically valuing it? Do you have your third eye open? Or are you completely blind to the reality of your own balance sheet, destined to end up liquidating your hard work while sitting on an unrecognized fortune?
It demands a massive shift in how you view the tools you use every day. And this raises an important question, perhaps the most important one to leave you with.
Let's hear it.
We have spent this entire deep dive unpacking how massive corporations are lobbying to build sophisticated accounting frameworks to put the value of your personal data on their official balance sheets, all so they can secure multi-billion-dollar loans.
Right.
If your daily habits, your health metrics, and your financial loyalty are the raw materials generating that billion-dollar value for the airlines, the casinos, and the banks,
Wow.
well, at what point in the future will everyday citizens demand their own personal balance sheets?
Wow.
When will the public demand the accounting tools to be the sole shareholders of their own digital worth?
That is a fascinating concept to mull over. The digital oil is real, it is actively being pumped onto corporate balance sheets, but the battle over who actually owns the well is just beginning. Thank you for joining us on this deep dive into the hidden assets controlling the modern economy. Keep that third eye wide open.